If y'all would, please take out in your folder that our staff provided you, there's several forms in there. One of them begins on our letterhead with a handwritten kind of letter on there for me. Will you pull that out? And then the illustration. There should be 5 pages of an illustration, and it looks like this. Got a red diamond, or what is that? Triangle. Okay, so pull that out, and we'll go through this. Now, I've got several tools here for you. So they're all going to be over here. We'll show you here in a little bit. They're $20 a piece. There's probably all different amounts, but that's too complicated. So give me a 20 skin and take a book, okay? But you need to have a supply of these with you. So especially Nelson's book, okay? This is by far the most important. So get with Renee and give her 5 20s and get 5 books, and keep these with you and use them. Do not give them away, please. Sell them. Okay? And I know that sounds weird, and we spend enough money where $20 doesn't really matter, but it's them giving you something of value and being in the boat with you. So please ask a 20 skin and give them this. Okay? Give them the book. Nelson.
I had somebody this week, they were online, and they said, well, I can get it for $14.99 on Amazon. And she had $15. And she said, can I give you $14.99? I said, no, you give me $20.
That's right.
And she poured out a $20 bill, but she was right.
So we're not booksellers, you know. I don't know where they could get it cheaper. Don't matter. Have them give you a 20 skin. You give them a book. Okay. Next one I want to reference real quickly. This is Who Not How. You heard me talk about this earlier. This is Dan Sullivan's book. You should be an avid student. The more you learn, the more you make. Okay. The more you learn, the greater impact you have on other people. So this is Dan Sullivan's book. Write down Who Not How if you would. And in his book, Dan Sullivan talks about Wellington. Not really by name, but kind of. All right, here's what he says. The famed historian Will Durant explained it this way. The ability of the average man could be doubled if it were demanded, if the situation demanded. In psychology, this idea is called the Pygmalion effect. And what it means is that as people, we're either rising or falling to the expectations of those around us. So the Pygmalion effect is very important to our culture in Wellington. I've already shared with you, it's a white glove experience, highly individualized, training, counselor-centered. That's our approach. White glove, which just means they get the best treatment we can possibly do for a client. It's individualized. We customize every single plan. There is no cookie cutter stuff that we do. Our clients don't want a cookie cutter. They want us to specialize a plan. Next, it's counselor training driven, not pressure sales. Okay? So that's that book. Next, How Privatized Banking Really Works. I have these over there also. Again, throw in a 20 skin and grab them, or buy 5, right? Don't be chintzy about this stuff. Have tools available for your clients. They need it, okay? And by the way, this is third-party validation in written form. You need third-party validation. You know, having one of our staff members talk to your clients is a good thing because they're going to validate you. They're going to affirm you. They're going to build you up, right? This does the same thing, just does it in printed form. So be sure to be generous with them. On page 208 of this book, which, by the way, is a required textbook if you're going to become an authorized practitioner. So for authorized practitioners, How Privatized Banking Really Works is a required textbook to study. Okay, on page 208, just write down page 208, and that our board of directors talks about the difference between the volume of interest and the rate of interest. I shared that with you earlier. But you need to get off of interest rates. Get off that. It's smoke and mirrors. Okay, it's a marketing ploy for the Ford dealership that says, "Oh, we got a 0.9% or 0% interest." It's a marketing ploy. If Ford Motor Credit were to move 1.5 million units this year in the United States, and they did that at 0%, which would be an effective loss for the company, they'd be out of business. Okay, it's a marketing ploy. It's baked in. So when you do get a 0% auto loan, it's baked into MSRP. Got it? Okay, this is next. This is Carlos's new book, Carlos Lara, L-A-R-A. He's on our board, and Carlos wrote the book, The Perfect Investment. Now, investments in quotation marks, in my viewpoint, I don't want you or the client to get confused that we're talking about an actual investment. We're not. We're talking about investment generically speaking, where your money is going, right? Because IBC platforms are not, repeat, are not investments. It's a banking system. And so you should have a network of accounts that are set up properly, funded properly, and then utilized properly for banking, okay? Not for investment. But on page 68 of The Perfect Investment by Carlos Lara, he says this. The big three components that make all the difference. Number one, think about this and money. Access and control over your money. Access and control over your money. If you have cash value in your policy, you have a contractual right to policy loans. Number two, the flexibility of repayment terms. You can pay back policy loans on your own terms or even not at all if you wish. Okay, so when you're in your banking years, you need to be banking. So while you have income years, you need places to put that, right? You even need a couple policies, or what I call cogeneration policies, that are not highly PUA loaded. There may be no PUAs or just a small little piece of PUAs. The rest of it's all base. You need policies like that because you need a place to put a windfall. If you have an amount of cash that comes in, you need a place where that money can live. So anything that you keep outside of your banking system, I had somebody the other day recommend I not tell you this. I'm going to tell you anyway. Your premiums and your income should equal. Now, sometimes people, they don't like that. It scares them a little bit. But let me tell you why that's important, okay? Because any premiums or any income that you take in that's kept outside of a privatized banking system, any of those, when you do that, you're going to lose a portion of it because you have no choice, okay? Let me explain that to you real quickly. Let's say that I make $100,000, and ultimately over the years I get up to privatizing $70,000 of it. That means $30,000 of it is outside of the banking system, private banking system. If you got it, say, uh-huh. Okay, so that $30,000, what am I going to do with it? One of two things. Number one, I've either got to spend that cash and I've got to give it to Jerome. If Jerome sells a car and I want to buy it, I got to give him the cash, which means I gave up the right to earn interest on that forever. Okay, so there's a price of that car, it's $30,000. The cost of that car is nowhere near $30,000. It's that times 2.2. It's $66,000 because our finances are not static, they're dynamic. And if I spent that $30,000 with Jerome and I paid cash for a car, that's money I could not put anywhere else, okay? So it could be put in one of our systems where it's generating 6.25% tax-free forever. But since I spent it, I self-finance. You finance everything. You either self-finance or use somebody else's financing. Since I self-financed, I gave up the right for that income. The other method is even worse, right? The other method is I go to Ford Motor Credit and have them pay for it. But either way, that $30,000 that I was not privatizing now is right back in the public banking system, and so I lose a piece of it. How big of a piece, Scott? It's about 15, 17%. Depends on your income. Higher income, the more you stand to lose. If you pay cash. If you don't pay cash, it's 34.5% interest by volume for financing it. Okay, so average those two. You're at somewhere around 20, 22, 24%. So of that $30,000 that did not get privatized, then I'm losing $6,000, $7,000. I'm just throwing it away. Okay? So access and control of your money. Flexibility repayment terms. Number three, off page 68 in this book. Number three, uninterrupted compounding of your money. Whatever amount you borrow, the same amount continues to earn money in the form of interest, dividends, and equity in your policy as long as you live and as long as your policy remains in force. Okay, so uninterrupted compounding. In fact, it's not really compounding if it's interrupted. Just like it's not really a guaranteed account if there's some way that there's volatility or risk built in, right? The only way it's guaranteed uninterrupted compounding is if it's in a system where compounding cannot be interrupted and monies cannot be lost. In a mutual fund, monies can be lost. In the market, in any form in the market, you can lose money, right? So by definition, it doesn't meet the need. Okay, so next one, the Feldman method. You guys should know, guys and gals, know the name Ben Feldman. He was the greatest insurance guy of all time. He's a legend. Now, he's way before our time, but he worked for New York Life. The dude was a stud. But here's what he said. He said, you need a staff. And this is his answer to Dan Sullivan. He didn't know Dan Sullivan, but this was his who, not how. If you come across a problem, and you say, Jerome, if I'm talking to our people and we decide we need to get our production to this amount, and I'm thinking I need to sell this amount of policies, and how do I get in front of business owners to do that? If I have to struggle with that, and I have to come up with the answer, and I'm not a business insurance expert, let's say, I've got to come up with the answer. I'm limited to my own knowledge and resources. You agree? If I find a who, if I stop asking the question how, but I start asking the question who, then I'm virtually unlimited in my resources. Because I could get this person for this person for this. Here's what Ben Feldman did. He's got one person that did all of his illustrations for him. He's got another person who handles all the correspondence. Now, he did everything, handwritten letters. He's got another person that does his travel schedule. Another person that was the office manager. So on and on and on, he identified who's that lifted the lid off his potential. Okay, so get a staff. Find a who. The last one, this is called the and asset. This guy's a fellow IBCer. He lists 16 characteristics. This is a unique list. Most list 14. Let me give you these real quickly. This is 16. This is being recorded, so if you don't have time to get it, or just get a copy of the book. Number one, 16 characteristics of the ideal financial vehicle. Number one, it's safe. Your money suffers no losses. Safety. Number two, it's liquid. You can access it and go change it into money whenever you want to. Home equity is not liquid. A bank loan is not liquid, right? They're not guaranteed. You could be turned down for it. Growth, your money multiplies. Number three. Number four, leverage. Number five, and that just means you can use your money as collateral. Number five, inflation protection. Your money grows at a rate greater than the rate of inflation. Number six, guarantees. There are contractual guarantees. There are three things guaranteed in a whole life product. Do you know what they are?
Guaranteed rate of return.
Rate is guaranteed. Premium's guaranteed. What's the third one? Death benefit. Okay? There's only one product in the financial services world in the United States that guarantees all three. It's a properly structured, participating, dividend-paying whole life policy. Okay? So that's guarantees. Number seven, free of fees. No fees attached to it. Number eight, free of regulation. Your money's not restricted. That's number nine. Number 10, requires minimal time. It goes on autopilot. Ed Rush, just a little analogy there, autopilot. Number 12, it's private. Your money grows without restriction, has creditor protections. Creditors can't go grab this money. Number 13, it's protection. So in the event of tragedy, it's going to give you some kind of benefit. Number 14, it's tax deductible. You can subtract any money you put into the account from your taxable income. The only way you can do that is if you have a corporate a business policy where the business is the owner and beneficiary of the policy. So the only benefit on this list that's typically not available to our contracts is the tax deductibility. Even it is applicable. They are tax deductible as long as it's a properly structured business plan. Number 15, tax-free growth, and number 16, tax-free distribution. So when I talk to somebody, I am loaded to the gills. So if anybody wants to have, some type of, I don't like the word debate, but if they want to have some kind of conversation about if my data is empirical in nature, if it's scientific in nature, if my data is accurate, we can back it up. So I want to give you guys everything that you need to back it up. So you're not thinking about religion, you're not thinking about a philosophy, you're not thinking about theories. It's just empirical data, right? We can say, here's the data. We don't have to like it, but it is what it is. Okay, you got this sheet? Okay, at the top of that sheet, I told you I want you to serve, not sell. And this is a practice, or this is a presentation that you can do in about 10 or 15 minutes. And so flip the page, and the next page should look like this. It's got the red thing on it. Struggle's real. Okay, so here's the process. A lot of people, from feedback I'm getting from y'all, is you're thinking, there's too much involved. I got to learn this about infinite banking. Got to learn this about Circle of Wealth. I got to learn this about products. I got to learn this about how to do an illustration. I got to learn this about underwriting. I got to learn this about e-apps and all, and it grows into this big monstrosity of stuff. So guess what most people do? Nothing, right? They put the brakes on. They don't do anything because it's too complicated. Okay, that's not true. Here's what your entire job is in, 30 seconds. You ready? Number one, your entire job is to collect names. Names. That's your inventory. Number two is to turn a name into a suspect. You turn a name into a suspect by knowing where they work and having some kind of contact data for them. You suspect you'd like them to be your client. Number three is a prospect. A suspect turns into a prospect when you have facts, a confidential questionnaire completed on them. And then number four, a client. A prospect becomes a client when they apply. All right, so that's it. The entire business that we do, the rest of it's just, learning, processes, right? But the first thing is collect names. You need to collect about 30, 40 names a week. You need to be in the name collecting business, right? Then you take a name and you turn into a suspect by having their a contact information and just where they work if you have that. Then that name becomes a suspect. This is called Al Granum's one card system. The suspect then becomes a prospect when you get facts. That's data. For our system, that's called the OCQ, the Online Confidential Questionnaire. We send them a link by email. They open the link. They give us about as information, not detailed. They don't have to go look up the exact to the penny balance. They give us about as information, right? Then it populates in our system magically. Poof, it comes out of the air and it's right there, and so we have it in front of us. And then we meet with them again and we find where there are inefficiencies. We bring our products to bear where appropriate and present it to the client, get the client's agreement, and we e-apply, okay? So that's the entire process. So here's the product. Let me talk to you product for a second. So number one, I put these in order, 1 through 30. 5 pages, 30 points. Okay, now 30 points, you sound, gosh, God, that sounds like a lot. It is, but I'm going to go through it kind of swiftly. And I want you to have these. I would recommend that you laminate these pages, and or if you want your information at the bottom and not Scott's, then print them off your software and do the same thing. So, number one, see the little red circle right there? 90% of all the prospects you'll see can do this plan. 90% of all the prospects you'll meet cannot do a $100,000 a year premium. 90% of all the prospects you'll meet can do $10,000 a year. They can do $10,000 a year. That's $830 some dollars a month. They can do that. How, Scott? They can collect that money from all different kinds of sources. They can go grab some money from their income. They can grab some money from a 401k they've had forever. They can grab some money from their savings account, from a CD, from an inheritance that they got. They can go grab the money from home equity. You can go grab all this stuff, right? Because all those accounts I just gave you are Dodd-Frank regulated. They're in the public banking system. So they're exposed. And if you read this, again, this is not my opinion, my theory, my philosophy, my religion. This is the law in the United States, banking law in the United States. So when 2008, 2009 happened, our government's response to that was what's called the congressional law called the Dodd-Frank Act. So when Dodd-Frank came to be, what that meant was no more bailouts, because you couldn't have a guy making $40,000 a year bailing out an investment banker CEO making $40 million. The United States would not deal with that anymore. There'd be a revolt, right? There'd be another Tea Party in the Bay. So they replaced a bailout with what's called a bail-in. What that means is, if you are a member of my bank, let's say, well, I don't want to mention bank names. You get in trouble for doing that. So let's say ABC Bank. ABC Bank's where I do my banking, right? If ABC Bank gets in trouble and they risk insolvency, then if you look at the plan document, they've all got some kind of arrangements to where they can attach those funds. They can do something called levying your account. Levy's a fancy word that just means they can take your money. Now, Scott, are you trying to fearmonger? Do you think, you don't trust banks? And well, for starters, I don't trust the banking system. Your local branch manager and people like that, they're good people. It's not them. It's the infrastructure in place. It's something called fractional reserve banking, which means we can deposit $1,000 there with the bank. Used to, they could multiply it times 8. Then it went to 12.5. You know what it is today? Unlimited. You know why? Say again? It did, but you know why? You know how it's unlimited? Because if they can have a deposit of 0, and they have lending power of $100, let's say, well, if you try to do that math, that's infinity, right? There is no, banks use somebody else's money to get their rate of return. So if you have no money in the game, but you get a 10% rate of return, your rate of return is really what? Infinity. Right? Because you have no investment in it. So anyway, this is just banking law. We have a summary. If you reach out, shoot me an email or shoot an email better to Hannah, she can send you a summary of the Dodd-Frank Act, 7 pages. You can read it for yourself. So $833 a month if funded 100% by income, $50,000 in an IRA, 401k, CD, home equity. That would fund the whole thing for 5 years. They wouldn't even need to touch anything. They could fund it for 5 years. Here's the next thing. It covers dad and 5 crumb crunchers. So this proposal is assuming you got a dad, and there may be a honey in the picture also. You just can't put them on the same product, so we'd have to write honey separately. But this is dad and 5 curtain climbers, okay? So they're all on one contract, okay? So far you're up to 6 policies. Life on dad, life on 5 individual children, $25,000 a piece on the kids. Guaranteed convertible for the kids too, by the way. Next thing you see there, $150,000 in accidental death. Scott, why did you include that? It's a good value. And I want to be able to tell the client, we are surrounding your IBC account. We're surrounding the assets. We're surrounding your cash value with benefits. We're planting a moat around your cash value. We're protecting it, okay? $75,000 cancer plan. Now, is it actually a cancer plan? No. Okay, but if we're going to go into the details of what the Care for Life rider does, and if you have invasive cancer, it pays. And there's all different kinds of triggers that Chris referred to earlier. So people are familiar with the cancer plan. That's why I listed it that way. $150,000 for a long-term care plan. Is it a standalone long-term care plan? No. But if 2 of the 6 activities of daily living, if your client can't do 2 of the 6, then it kicks in this benefit. Okay, there are some limitations to the benefit, but that's $150,000. Okay, so so far we've got the life insurance on dad, life insurance on all the kids, $150,000 accidental death, $75,000 cancer, $150,000 long-term care, $5,000 in disability income benefit. Why? Because we're going to pay the $5,000 because it's got waiver of premium. So if they go 6 months, they're out, sick or hurt, can't work, they become disabled, then the waiver of premium benefit kicks in, pays the benefit. Okay, so they've got that. They've got $385,000 in a retirement fund at age 65. $385,000 is in it. Plus, that breaks down to $22,000 tax-free retirement income. $22,000. So you gave the client all those things for $833 a month. You gave them retirement, you gave them 10 different insurance protections, and you covered dad and 5 kids for $10,000. $10,000 for the year. Okay, that's number 1. Number 2, 10 different insurance benefits covering 6 lives plus retirement. Number 3, see the red 3 circled? Death benefit, cash value, premiums, all guaranteed, plus dividends. Is a dividend ever guaranteed? That's an incorrect answer. Let me rephrase the question. When is a dividend guaranteed? When it's declared. When a dividend's declared and credited to the account, guaranteed. Well, Scott, of course it is. Well, no, not of course it is. When you get a distribution, when your mutual fund recognizes growth, that growth goes in there, but is it guaranteed? You can lose it all, okay? Everything, we just reset a new floor by paying a dividend. Then we're going to reset a higher floor the next year by a dividend. And we paid a dividend every single year. Okay, turn the page, please. The next page should have 3 little arrows. This breaks down the living benefits. There are 18 total triggers to trigger a living benefit. Again, we're putting a moat around their money. If they've got a 401k, y'all, they don't have a moat around their money. If they've got their money in CDs, they don't have a moat. If they've got their money in home equity, every dollar extra that they pay in addition to their principal is moving them sequentially further away from financial independence. They're at risk. You should not be prepaying principal. You should not be paying extra to take a 30-year mortgage and make it a 15. Why in the world would you do that? You got to qualify to get your money, quote unquote, back out of the house. Stop. You want your money liquid. You want your money close to you. You don't want it to reside at the mortgage company. You say, well, Scott, but my house is going to appreciate. Your house will appreciate whether you have a mortgage on it or not. Right? It's still going to appreciate. And if there's 10 houses on your block and a tornado rolls through and all 10 houses are wiped out, and you, because you listened to the financial know-it-alls in the world, decided to pay your house off. Now guess what you got to do? You got to fight with insurance companies and you got to fight with the adjuster for what? For the value of your house. Okay? If you've got a big, hairy, scary mortgage, which you should have and you should maintain it as long as you can, if they'll give you a 40-year mortgage, take it. They'll give you an interest only, take it. If you can keep it for the next 100, keep it for the next 100 years. But if you've got a big, hairy, scary, I'm not saying to be in debt where you can't pay it off. Have the money to stroke a check, right, to pay the mortgage off. But don't give that money to the mortgage company. That's dumber than dirt, right? And so when that happens, if you've got a big, hairy, scary mortgage, you don't have to worry about fighting for yourself. The mortgage company will ensure that they get a check for the payoff of the value of that house and its contents, okay? So 18 total triggers: critical illness, chronic illness, terminal illness, living benefits. That's what you need to talk to a client about. Living benefits, right? Okay, turn the page, please. Are y'all okay? Are y'all mad? Y'all got quiet. All right. Smile at me every now and then so I know you ain't mad at me. Okay, number 9. More guarantees than any financial product, period. It's listed right there. And instead of you just saying it, for you being able to say it on a laminated copy and slide it across the desk, say, see, Mr. Client, Mrs. Client, right here. It's just helpful to be able to back things that you're saying verbally up in writing, okay? If you skip down to number 10, we're up to number 10 already. I had this built, 50% base, 50% paid up addition. Now, for some of the spouses or significant others here, that may not mean anything to you. So let me explain it. In insurance vernacular, with a whole life plan, you've got a cost of insurance for the whole life. It's the most costly insurance product there is, a whole life, okay? Why do you think it's the most costly type of insurance there is? All guaranteed. I just took, when I give the insurance company this money, I just took all the risk and I shoved it across to the table to the insurance carrier and I said, you keep the risk. You keep it. I don't want any risk, right? Now, anything I pull back on this side of the table is going to lower my cost of insurance, but I'm going to absorb the risk, okay? So I'm asking, because this is a banking system and not an investment, banks don't have typically risk involved with them. Not like the market. You know, when you go in the market, you risk it depleting. That's typically not the situation with a bank. With a bank, you want your money to be guaranteed, right? So all these guarantees come with it. Go down to back on number 10. So the base part, that's the part that's associated with the COI, cost of insurance for the base whole life, most expensive product out there because of the guarantees. So what most insurance people do, you're not an insurance person, by the way, not if you represent Wellington the way that we train you to. You should become a specialist. And that specialist should be in the infinite banking system, okay? But our goal is not to just make everyone fit into the infinite banking system. Our goal is to determine what their needs truly are and then use one of the most powerful concepts out there, a system or a network of accounts, to help address financial needs and build financial liberty. We're after liberty for the client. Once you start to accumulate these things for yourself, you should give it away. You should want to make the lives of other people better. So half of it, with somebody that doesn't work for Wellington, all of that $10,000, all 10,000 of it would be base. That means they got a big fat commission. Okay? For us, in this case, only 50% of it was base. 50. The other 50% went to something called paid up additions. That's insurance vernacular for cash. We're moving cash to the client. And what it does is every year it buys a chunk of paid up insurance. So there's no more cost of insurance on it. All the costs are paid. The overhead's gone. It's streamlined, running like a deer, right? So it adds a chunk. So after 10 years, you've really got 11 policies. The one that was issued the first time, the first year, then that next year added a chunk and then another chunk, and then every year adds a chunk to it. Now, we don't break it down that way. You really only have one, okay? But it adds a chunk every year with that. So with Wellington people, because they're giving half the money to the client, they give up half the commission. That's what happens. There's no way. An insurance company will not give you all the money and give your client all the money. There's not enough money to do that. And insurance companies are smart. They rule the world. So there's a reason why they have that kind of financial wisdom, right? So we're asking you, be a giver. Give up half your comp. Why do that, Scott? I think if you do that, you're going to, well, first of all, you should do it to help the client. But secondly, if you do that, you're going to make more income. You're going to make more income because you're going to write larger cases and more of them. Because when a client knows, so I can give all this money to my insurance carrier and I have zero in cash if I deal with ABC company, or if I give my cash to Marty at Wellington, 5,000 shows up the next day. 5,000, zero, right? So you'll do more this way. Okay, so let me show you the breakdown. Number 11. So $5,000 a year is the cost of insurance. That's broken down to 4 different insurance benefits: the whole life, the death benefit, children's insurance, and waiver premium. So those 4 things adds up to a total of $5,000 a year. The other side, $5,000, goes straight into paid up additions. Now look at number 12. There's where you see the paid up additions, right? FPUR is this paid up rider. Okay, number 13, that's the accidental death, then the children's, then the waiver. Are you with me so far? Okay, turn your page, please. Now we're up to number 16. The most important number on the whole page is that $28. Okay, the reason why that $28 is important, because it comes out of the gate right up front. You see it the first year, and it's a dividend. Y'all say the word dividend. That's a beautiful word. This is the only type of product that issues one. Okay. Other types of cash value plans, they give you credited interest, but not a dividend. A dividend has 4 or 5 different options of how it can be spent each year. We've asked the insurance carrier in this example, take the dividend and buy a little chunk of paid up insurance and just stack it on top. Just keep stacking. Why keep stacking? Because it's death benefit if the client dies. It's cash. It can be immediately, it's liquid between the two. It could be cash or death benefit, either one. So it's a beautiful thing. So that $28 coming out of the gate right there, it shows that this is a unique kind of product. It paid a dividend, okay? So you're not renting the policy. If you've got a universal life policy, there's nothing wrong with universal life as long as you use it for the right purpose and you understand what it is. Nothing wrong with it. I've sold them before. Don't tell anybody, but I have. So a universal life policy is really a term policy that builds some cash on the side. It's a 1-year term that builds cash on the side, okay? Because every year, as you age up, you know, a funny thing happens. When you have a birthday, you get older, right? So when you get older, the cost of insurance climbs up a little bit every year and continues to do that. Not much in the early years, a whole lot in the latter years, okay? So if you position it properly, you know, this is what Chris mentioned earlier. If you position this product properly, and it's for an insurance benefit, for an insurance play, for an insurance cause, for an insurance need, get the word insurance? It's not a banking product. People that have tried to use a universal life of any flavor, there are all kinds of flavors today. Most of them came out because they got sued about the previous flavor, so they come out with some kind of adjustment, right? But all those flavors today, all of those are term insurance that builds some cash, and they're not for banking. They're not for banking. In fact, if anybody and that's not just our group, but if I did this and I took a universal life product and I presented it to a client under the guise of being a Nelson Nash infinite banking contract, I would be terminated. They'd kick me out of NNI. They would disparage me, talk bad about me, throw rotten tomatoes at me, the whole deal, because it's a bad deal. Now, why would people do it? Why do you suppose somebody would sell a universal life as a banking product? It's cheaper. What else? Commission, baby. Commission. You make more commission. Because I can set that, it's called flexible premium, adjustable life, right? Flexible and adjustable. So I could set the premium down first year just to the whatever the what's called target is. I get commissioned on all of it then. Now, they don't have any cash show up, but I get commissioned on all of it. Then the next year I can go back and I can inflate that number way, way, way higher when my commissions have already been paid, right? So then I can put the extra above target premium into that universal life. And it doesn't hurt me, and it looks good to the client. So it looks good as it's accumulating, not a banking product. Okay, number 17. The instant cash value you see pop up there is $51.61. Instant money. Most whole lives take 4 years before they show up in any cash. Number 18. Every year, the death benefit's growing by about $16,000 when it first starts. So you see a climbing death benefit, $16,000. So the $10,000 in premium gave them 10 different insurance benefits, 10, plus retirement, plus it goes up by $16,000 death benefit a year, plus it showed up $5,100 in immediate accessible cash. Tax-free. Pretty good deal. Number 19. If you go down to the end of 10 years, this plan's accumulated $91,000 and some change. You paid in how much?
86 to 83.
How much have you paid in after 10 years? 100,000. Okay? So if you paid in 100, you got 91,000 back. Is this a good deal or not? Amazingly good deal. Now, we have other plans, like what Chris was referring to earlier. If we did an Access Whole Life, that number would be even higher. That cash value would be higher. So, Scott, why'd you show a growth? Because this person is a long-term growth play with retirement. A long-term growth play with retirement, the growth plan outperforms the Access beyond 15 years. Is Access a good plan? I own them. Of course, it's a great plan. Growth is also. I just want you to see that. Not everything has to be 60% PUA and 40% base. This is a 50-50 plan. And by the way, the higher you go on the base drives the living benefits. So if you lower the base down and stack in a bunch of cash, you just lowered your living benefits. Yes, sir.
So is there a certain age where you want to push, especially with the growth whole life versus the Access?
I think virtually for all young people, we try to put them in a growth if they're young.
And up to what year, 40?
I would say 30-ish, 35 or younger than that, I'd put them in growth. Or if their trajectory, if their time horizon is 15 plus years. If somebody is wanting to go buy a car and they need to deposit 70 in to go get 60 out now, growth is not the plan. They need an Access. Access gives them, as the name implies, immediate access. Okay? So that's 19. Where's number 20? Okay, on the left. See number 20? The premiums stop after 20 years. Or 25? Sorry, 25 years. Okay? 25 years, we stop the premium. Why? Because they're at retirement. Do they have to do this? No, it's just an idea. 25 years, they stop the premium. Okay? So at age 25, or at age 65, after 25 years, if you go all the way to the right, see number 24 over there? That's the death benefit, $653,000 and some change. That death benefit is lower than the year before. Do you know why? Not exactly. Okay, if you look at number 24 circled on the page, see number 24 in red? Right below that is the death benefit, $653,000. It went down from $771. Do you know why? Neither one of those. Nope. It's not the disbursement or the cessation of premiums. Neither one of those things is the reason for that. The reason for that, say again? Nope. The reason that it went down is we did something called reduced paid up, RPU. So what we asked it was, how much death benefit will $383,000 cash buy? And it tells us it won't buy 771, but it will buy 653. So we asked it to buy 653,000 and we stopped the premiums. It's not required that they do that. They don't have to decide that for 25 years. It's guaranteed age 121. Okay, so look at number 21 up there, by the way, in red circled. Right below it's the word higher. Those are higher dividend. This K-Dog goes back to the question you asked. Higher dividend distributions are kicking in there. If you were to compare that to Access, they'd be a little bit lower. But Access up here in the early years is higher. Two great products for two different needs, right? 22, retirement income. I like this part. This is fun. So retirement income, $22,000 a year. We're spending that off tax-free. 23, 20 years of retirement income. That's about $450,000. I could have gone longer, could have gone shorter. You can do whatever you want to. Now, if it were an annuity, once you do an annuity and you turn on retirement income, at that point in time, you give up the check. So let's just say $385,000 is the cash value at the end of 25 years. Do you see that? $385,000 some change? Everybody see that? Say, uh-huh. Okay, so that $385,000, if you were to buy an annuity, it'd give you guaranteed income for life, but you have to take that $385,000 and shove it across the table to the insurance carrier and say, bye-bye. You can never access it again because it's gone. It goes to the insurance company and they're going to exchange it for a guaranteed retirement income for as long as you live, if that's what you designate. What I've chosen to do here is say, don't do this. Me and Keith have done this many times. We've said, don't do the annuity. Nothing wrong with an annuity. Great product. But in this case, we want you to retain the option to take a lump sum of cash or to take a retirement income stream, either one. We don't want you to give up the lump sum of cash. This retains the lump sum of cash and gives you retirement income. Okay? Again, they're both great products for different purposes. 25, not bad for a bank. Turn the page, please. Almost done. So 26, this is important, y'all. So important. Every time you open a new policy, you've opened a new bank. Each policy, when we structure them properly, are banking conglomerates. They're part of a banking conglomerate. Every new bank is a new business. So a new policy is a new bank. A new bank is a new business. A new business is a new profit center. So if you have 10 of these, you have 10 potential profit centers that you're expanding and growing. So you need to start thinking like the banker, not the bank customer. Bank customers think about how much are my payments, what's the interest rate, how long do I have to pay it back? You know, that's the way a bank customer thinks. You got to get out of that. All of us. I slip into it from time to time too. When you catch me doing that, shake me gently and say, Scott, you're thinking about like the bank customer, not the bank owner, right? So we're trying to make our clients owners. So 27, it takes an average of 7 years for your business to be profitable. I just told you each one of these is a new business. It takes about 7 years. Now, can we turbocharge it and do it faster? Yep. Can we pull some of the money out and do it slower? Of course. So it's got all kinds of flexibility, but it is a profit center. Most people have never been taught to think of their whole life insurance as a profit center. But that's what it is, if you do it properly. 28, after 7 years, the cash value is going from $46,000 to $56,000. So all the premium went straight to cash. Premium, cash, 100%. That's what we call efficient, right? It became efficient there at that point in time. Look at number 29. So if we go down to year 19 of this contract, for every $10,000 they put in, it grows by $20,000. That's a pretty good return, right? 200%, not bad. If you go down to the end of this at age 65, every $10,000 you put in is growing by $27,000. So just think of how many dollars you would go grab. Y'all focus on me for a second. I'm almost done. If you knew this was going to happen, and you're 25 years out. Remember, the airplane gets more efficient every year. You can't take off at LaGuardia and turn around and land because you're loaded down with fuel headed toward LAX. You can't do it, right? You got to burn off some fuel. You got to get lighter. These become lighter and more efficient every year that passes. Okay, so if you knew you were going to get to a time where every dollar that you went through the deposit line, went through the drive-through line, you gave them $1, and you knew they were going to give you a deposit credit for $2.70, how many dollars would you go find? When you find a bunch of dollars, this will happen. It's not speculation. It will occur. It's not the market. The bottom circle, I didn't put a number by it, but the bottom circle there is every time you open an account, you're starting a new business that didn't exist before. This was a big point. Nelson hammered this all the time. Every time you open an account, you're starting a business that didn't exist before. Questions?
Scott, can you speak to a lot of online people who are designing policies like 2080, 20% base, besides the smaller living benefits that might occur? How does that, maybe Chris, if you want to chime in terms of what
Sure.
the ramifications are on that?
Sure, it's a modified UL. It's a whole life that they've made look like a UL. What's a UL? A UL pays a very low guarantee. Then it's hoping that the additional monies going in will generate some additional interest, right? So the client retains all the risk in a UL, a lot of it. They're retaining a lot of the risk, right? So what we did is we took a whole life product that was all guaranteed, and we said, no, we just want a little bit, we want 20% of it to be guaranteed. We want 80% of it to speculate, to a degree. So that 80% is dividend dependent. Dividends before they're issued are not guaranteed. Now, we're not saying they're not going to be issued, okay? These companies have a great track record of it. But what we've done is we've shifted the type of insurance. In that case, they'd be better off going to get a UL. Better off buying a UL. Now, I wouldn't do it. I wouldn't use it for banking. I don't believe in 90-10 plans, 80-20 plans, never have. But I know some people love it. I don't think it's a valid business structure. And I think you as a practitioner, especially you, because you're an authorized practitioner. So the standard we have as a fiduciary, we have a built-in consumer advocacy group that we have to sign a pledge to every single year, right? They protect the consumer. They protect the clients. So we pledge to put the client's best needs first. And structuring an 80-20 plan is not putting the client's best needs first. Other questions? Yes, ma'am.
So at the beginning, you said that to try to flow everything, that you're going to want to flow everything through the account. Maybe we should get these guys to cover their ears. But how do you do that? Because new here, right?
Right.
But I'm under the impression that we can really only do about 25% of
That's exactly right. It's a great question. So, don't say this around Jim or Chris. Underwriting gives us some flexibility if you have a guaranteed convertible term rider. So two things need to happen. We can convert a chunk that would put us above 25% of the term to another base whole life policy. We can convert a chunk of it that they wouldn't let us come out of the gate with. However, it's still, even though it's guaranteed convertible, it is underwritten. There's still financial underwriting, okay? And we've stumbled across this. It's the greatest challenge we face. How do we get more money in this thing? The client wants to put their money in it. Because when you get a client that sees this, they're like, I'm in. I'm in. This is what makes it so beautiful for us. You don't have to hunt them down. 6 months later, they'll come back to you. Say, I need to put some more money in this thing. I want to buy this or I want to buy that. They'll come hunt you down. So you need to do two things. You need to convert term and show an increased income. Now, I'm not saying fabricate it. You just need to grab all sources you legally, ethically, accurately can to show an increasing income. And then I'll let these guys speak to that. But to the best of my knowledge, it is still underwritten, but you do have more flexibility if you can show a guaranteed convertible term rider that we're going to convert a chunk of it and their income's rising. Chris, Jim?
Agreed. And, keep in mind too, not only their income, we can look at net assets.
Good point.
Okay.
Any kind of assets.
Asset-based.
Heck yeah.
Yeah.
Y'all hear what they just said? What Tammy was asked about? Assets are a big deal with not just income, but assets also. Other questions?
So if you look at income, we'll do a certain time, just their income, we'll do a certain time as premium, but if you add their asset, it'll open up a whole nother window. And I have an important like and set it back to Scott.
Yeah, perfect.
Right, we're gonna financially underwrite the case, as you try. So on some of these bigger cases, and we've been through it with many cases with you, the underwriter is gonna request sometimes financial documentation. That could get into what Chris just said.
Yep.
Maybe there's some unusual circumstances that they can take into consideration, and we will take it into consideration. But in terms of just the guidelines are what they are.
That's right.
And certainly Chris or I or anyone couldn't advise you to go outside of those, because those are there to protect you as and the client and us.
Right.
But you've got to present the case. So we
Well-
have no problem with you presenting, the case if you think there's a need to push the limit, so to speak. But just do it transparently.
And we've got 3 home office guys in here, so would you tell me if you guys would agree with this? So since we like the insurance company's guidelines, by the way. Now, it doesn't always seem that way because we want them to do 100% income day one. But there's a reason why they don't, okay? And these guys know what they're doing. They're very profitable. And when you take out a policy, you become a part owner with the insurance company. So the last thing you want to have happen is for the insurance company to lower their rates. That'd be double dirt dumb, right? You just cut your own profitability on your own policy, right? So we want to establish and adhere to that best we can. Is that fair, the way I said that?
It is. I mean, there's no question. Those rules are there for a reason. And there's times when you may have a situation where you want to go beyond that. Just present the case. I think that's going to be your best long-term.
Transparency and accuracy, right?
You're developing a relationship with the underwriter. So you've got a brand.
100%.
Many of you in here have gone through that. They will work with you, and they're going to guide you in the right way. So that would be my recommendation. It's protecting you as well, honestly.
Okay, any other questions?
Scott, when, you talked about a 2080 plan, it's not really 80/20, it's 20/80, 25/80.
Yeah, either way, yeah.
And 10/90. So what's the best way you would describe, because when I get to Atlanta, I've got a situation where somebody told this guy, hey, just throw your money in, just turn around and throw it back out. So what do a 10/90? What would you say to him?
Kind of how I answered Lawrence. It's well, possibly, but you could set up a plan to overfund it to that degree where it doesn't become a mech. But that's not an NNI structure. Nelson never recommended that, and there's a reason behind that, right? So when you only have 10% base, you stripped all the guarantees out of the contract. Not only did you take all the living benefits out, you stripped out all the guarantees, because dividends are not guaranteed before they're issued, right? So they might as well go with a UL, but I wouldn't recommend it. They're better off doing a UL if they want to do that, because that's what they've got. They've made a whole life look like a universal life, is what they've really done. But Nelson, by the way, let me just say this to you. A lot of people want to put 100,000 in to pull 90,000 out tomorrow. Nelson never recommended that. I know people probably don't like hearing that, but Nelson wanted you to fully capitalize an account. He would tell you up front, don't be afraid to shove money in there and let compounding go to work for you. Then once you capitalized your bank, then go grab the money out that you need to go buy stuff. Now we know in real life, some of our clients need to do that now, right? Or they've got a big expenditure now. I'm just saying that's not ideal. If you could wave a magic wand and have the ideal happen, the ideal is to fully capitalize that thing for 7 years. 10 or 20 is better, but 7 years, fully capitalize it, get by TAMRA, TEFRA guidelines, the 7-pay guidelines, get past that, right? Fully capitalize it, then access the money. But like I said, some clients need the money now. Yes, ma'am.
No, I was just going to ask, so this never becomes a MAC?
No, does not.
Is it because we're pulling the money out
No.
for retirement? Oh.
No, it has nothing to do with that. Remember the money, she just asked, does it not become a MEC because we're pulling money out from our, we're not pulling any money out.
For the retirement, I just meant for the retirement.
Right, no, even for that. Now what I did on this one's a little differently. I did this one, since it was retirement income, I had the client pull their basis out first. So these are true withdrawals, not loans. And then I had them kick in loans over and above that. But no, that's not the reason. The reason, because you only have to get past 7 years, 84 months, because the money that gone in there, even if a MEC doesn't kick into year 20, the mechanics for that was laid down the first 7 years.
Okay, so unless they convert or do something that changes the.
Correct. Well, there's only two things they can do to prevent a mech. Pull the rug out from underneath their premium payments, stop those premium payments because you're putting too much money into it, or if there's some provision for increasing the face amount. Mark.
That 1090, correct me if I'm wrong, in order to get 1090, they're going to have to put so much money in term to prevent the mech.
Yep.
That they're really spinning their wheels. That money going to term that they don't need, they might not even get qualified for, could be going to the base.
This guy had like $1 million, he wants to buy a quick piece of property.
Yeah.
They wanted to stick $1 million in it, and somebody told him we can take it right back out, and that kind of thing, and he really killed it.
You can't really. Now, notice on this, y'all, that handout I gave y'all, how much term insurance did I have to add to stop it from being a mech? None. So if you've got a client that you want to move in easily and get out of underwriting easily, stay below $1 million or $2 million, stay below those thresholds, this doesn't even add term insurance. It still rock and rolls with cash, and no term is required to stop it from being a mech. Yes, ma'am. One more question, then we got to move.
You might have to answer this, but it got confusing for me as to whether we get people to throw everything up in the front, every year annualized at the beginning, if it's going to earn interest from the very beginning, or is it something that the interest is paid out at the end and it wouldn't have mattered if you had paid in?
That's not true.
Policy?
No,
That's what I
it's
was-
the first case. So if you have a choice, you got $1 million and you put $100,000 a year for the next 10 years, or you got $1 million and you can shove it all in there now. You're always better off to shove it in. Now you can't because it'd be a mech, but shove it all in as fast as you can, because then you got more money, earning more compounding for more time. Well, you can't and it not be a mech. There are some ways we get around. The minimum you can do is 4 years. Plug your ears. You can do 4 years is the minimum funding time that you can have with any carrier. So used to you could do a 10 before the Tax Reform Act of 1987. Ralph Nader got together with A.L. Williams, and the two conspired to bring down whole life companies, and to a large degree, they succeeded. Even today, the reputations of whole life companies has been damaged. Everybody says, buy term, invest the difference, and it's just crazy. Yes, sir. One more.
If a prospect doctor, his first goal is wants to pay off $200,000 in school loans,
Yep.
but that's against Nelson's concept, which
No, I wouldn't say it's against his concept. Well, no. You're better off putting $220,000. Keith, back me up on this one. You're better off taking $220,000, putting in the policy, taking a policy loan, paying off the student loan debt, and then repaying yourself just like you would have been paying the student.
There would be lower interest paying at that.
Probably. I would guess so. I don't know about that, but it doesn't matter. The interest rate doesn't matter at that point because it's going back to you, right? It's staying in your self-contained system. That's all you're doing. See,
You were making the student loan, that's the point.
That's true. Yeah. Now maybe 5% of it's going to repay the insurance company because the money didn't come from your account, it came from the insurance company, right? But everything above that goes right back to your